Hello, everyone. Welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. Going to kind of jump into this week's slide. There's been stronger than expected jobs growth, and inflation is still pretty mild. So investors are now having to reassess their long-term outlook for policy rates. You can kind of see what's going on here. If you look on the left-hand side at the bottom of the chart, there's three different colors, one from October 18th, one from January 12th, and one from February 23rd. This basically shows that we went from having a really low chance of having rate cuts, 2.67 rate cuts on average, that'd be between 2 and 3 obviously, to a situation where we may have as many as almost 7 rate cuts as things got a little bit more difficult in January. Since then, the outlook has looked much better than it is right now, and we're now down to about 3.29 rate cuts. That's kind of the average. So let's call it between 3 and 4. Now the average rate cut is about 25 basis points. They usually won't cut it unless 25 basis. Sometimes they'll go 50. So that means we're probably looking in the neighborhood of between 0.75 and 1% rate cut. The Fed actually says that most people are thinking it's about in 0.82%, which doesn't really happen, but that's kind of the average what they're kind of expecting. So between 0.75 and 1%. Now with that, bond and stock markets are obviously responding to this. Many of you that are holding short-term bond funds or bond funds to be able to kind of keep your portfolio well diversified due to market fluctuations should see big pops in your portfolio on the bond side when the bond rates are dropped and the Fed drops those interest rates. Having said that, in the meantime, any bonds that are being renewed will be purchased back at the higher rate until these rates go down as well. So there'll be a double whammy on those that are holding bond funds. It'll be really nice to see that. From an equity standpoint, from the stock standpoint, I think you're seeing since October the market has been on a tear. Even year to date, it's up almost 7%, the S&P 500. So I think we'll continue to see that. The Fed likes to see inflation under control, and the market likes to see the Fed dropping rates. As the Fed drops rates, the market should do well. Obviously, we still want to maintain broad diversification in your portfolios to make sure that we're taking care of all sorts of different risks that take place in the economy. But from a U.S. stock market standpoint, this is really good news. With that, we'll let you run till next week. Feel free to forward this to any friends or family members that you have that you think might be interested in it, and we'll talk to you next time. Thank you.